To start with, I will go through the key economic indicators and our expectations for 2021. As you can see on the graph, Sri Lanka's GDP growth has tapered down from 5% in 2014 to 3.3% in 2018. In 2019, as a result of the Easter bombings and associated impact on tourism and the economy, real GDP growth eased to 2.3%. In 2020, pandemic-related lockdowns saw the economy contract by 3.6%, with nominal GDP recorded at $80.7 billion. Although a contraction was recorded, the economy outperformed expectations. Asian Development Bank expected a contraction of 5.5%. IMF expected a contraction of 4.6%. Fitch Ratings and World Bank expected a contraction of 6.7%. The economy contracted in the first quarter by 1.8% and 16.4% in the second quarter, owing to pandemic-related lockdowns. However, the economy rebounded in the third and fourth quarters, recording quarterly growth rates of 1.3%. This was despite restrictions due to the resurgence of COVID-19 in October of the year. In 2020, the three major sectors, agriculture, industries, and services, recorded negative growth rates of 2.4%, 6.9%, and 1.5% respectively. All sectors rebounded and contributed to the growth in the third and fourth quarter. Growth in 2021 is expected to recover with a gradual normalization of economic activity. The Central Bank of Sri Lanka forecasts a higher growth rate of 6% compared with ADB, IMF, and the World Bank, whose forecasts range from 3.4% to 4.1%. The government's efforts towards strengthening domestic production to encourage self-sufficiency is expected to enhance production in the agriculture sector. Earnings from industries and services are expected to gain strongly owing to the revival of global demand and resumption of production, which was disrupted owing to the lockdowns. Businesses are expected to benefit from monetary stimulus in the form of lower interest rates. The cheaper cost of funding encourages capex expansions and in turn drive earnings growth. Businesses are also expected to benefit from fiscal stimulus in the form of tax reliefs and subsidies. Preventive measures such as restrictions on travel, isolating areas have been imposed to manage the pandemic. A systematic vaccine rollout is expected to be implemented to sustain business continuity during the second half of 2021. On the 13th of May, the government and the World Bank signed $80 million of an additional financing facility to help Sri Lanka access and distribute COVID-19 vaccines and strengthen pandemic response. The government plans to vaccinate 60 to 70% of the population by end of 2021. All these measures will help local businesses carry on continuous operations and contribute in achieving positive GDP growth in 2021. As reflected in the graph, although a decline was witnessed in the first two quarters, the corporate earnings witnessed strong growth in the last two quarters of the year, with a growth of 92% and 20% respectively. The highest ever quarterly profits was recorded in the fourth quarter of 2020 at 94 billion rupees. Listed company earnings are expected to grow at a faster pace in 2021, in line with the GDP growth forecast. Inflation rates remained subdued during 2020 due to a downward revision of prices. Although during the year, prices of food and certain essential items increased owing to pandemic-led supply disruptions and unfavorable weather conditions for agriculture. The annual average headline inflation for the National Consumer Price Index and the Colombo Consumer Price Index were 6.2% and 4.6% respectively in 2020, an increase from the 2019 levels. The year-to-date annual average headline inflation based on the National Consumer Price Index and the Colombo Consumer Price Index are approximately 5.3% and 3.9% respectively. Inflationary pressure may arise in the medium term due to possible supply disruptions as Sri Lanka battles its third wave of the pandemic. We expect inflation to remain at mid-single-digit levels in 2021. Removal of import restrictions and rupee depreciation may impact inflation in 2022. An accommodative monetary policy stance was implemented since the fourth quarter of 2019, which saw deposit and lending rates decrease to single-digit levels in 2020. In order to stimulate the economy given the pandemic, the government decreased the one-year Treasury bill rate to around 5%, which would not have been politically possible in the past. The average weighted deposit rate declined from 8.14% to 5.07% from January 2020 to April 2021. As you know, local and foreign institutions have not been active buyers in the stock market in 2020 and 2021. We expect the same trend to continue for the rest of the year. However, there is not much to worry as the decrease in deposit rates has ensured a daily steady flow of maturity proceeds from fixed deposits and treasury bills to the stock market in 2020 and would continue in 2021 given the low interest rate environment. This has resulted in daily turnover levels increasing. The fixed deposits in the banking sector is approximately 7.56 trillion rupees as at 31st March 2021. The central bank is expected to continue to support the economy through an accommodative monetary policy. We expect interest rates to remain at these levels in 2021. The prime lending rate has declined from 9.68% to 5.67% from January 2020 to April 2021, and the benefit for the stock market is twofold. Firstly, companies will benefit from low-cost funding that will drive investment and earnings. Secondly, equity portfolios will also be able to generate increased returns by leveraging their portfolios and borrowing at low interest rates. We expect the average fixed deposit rates to remain below 5.5% in 2021. In addition, inflation is expected to be between 4 to 6% in 2021. Accordingly, if fixed deposit holders do nothing, thinking it is safer to remain in fixed deposits, then there is a possibility of zero or negative real returns. Therefore, an investor needs to be innovative to boost returns on their investment. With prime lending rates expected to continue at current rates in 2021, investors should leverage against their equity portfolios at single-digit funding rates to maximize their returns. We expect the total returns, which consists of both capital gains and dividends from stock investments, to generate returns far exceeding fixed deposits even after interest costs are accounted for. Some of the benefits of a margin trading facility include the ability to obtain additional purchasing power of up to 50% of the portfolio value. This provides an opportunity for investors to buy shares at a good value when the market dips. The margin trading arrangement also automates the settlement process, as it is done by the margin trading institution. To mitigate risks, you can voluntarily use margin up to about 35% and single stock limits of about 30% on your portfolio. The trade deficit narrowed in 2020 from 9.5% to 7.4% of the GDP due to combined effect of exports reaching pre-pandemic levels sooner than expected and import expenditure declining. The decline in imports is owing to the curtailment of non-essential imports and the government's policy on import substitution. In the first quarter of 2021, the trade deficit has widened to $2.06 billion from 1.85 billion in the corresponding period. Earnings from exports improved by 12.5% as textile and garments grew by 6.3% and agriculture exports grew by 31%. The deficit increased in the first quarter as imports grew by 11.9% compared to the corresponding period of the previous year. This was as a result of relaxation of certain import controls and the 14.7% increase in pharma imports and 3% increase in fuel imports. Textile and garments recorded $4.4 billion in earnings in 2020, a decline of 21% over the previous year. Apparel sector is currently facing challenges owing to the disruptions in production during the pandemic. However, the sector has capitalized on opportunities in production of personal protective equipment when the demand for apparel contracted in 2020 due to the lockdowns in key markets. The first quarter performance for textile and garments has been strong, with a 6.3% growth recorded year on year. The worker remittances rebounded to $7.1 billion in 2020. Further, a growth of 16.7% was witnessed in the first quarter. The export sector companies were given permission to operate amidst restrictions in movement to ensure business continuity. The Export Development Board forecast $12 billion for merchandise exports during 2021. The government has set a $6 billion target for the apparel sector in 2021. We believe this target might be a tough task with the third COVID wave affecting factory workers and disrupting many operations across the country. However, given the government's intention of vaccinating over 60% of the population by the end of the year and the industry push to prioritize factory workers, we can expect earnings to improve in the third and fourth quarters. The gradual recovery of tourism is also expected during the fourth quarter of 2021 through to 2022, with focus on safe travel and issuance of certifications to enhance assurance for travelers. In the medium term, stimulatory fiscal measures and policies to enhance local production is expected to reduce reliance on imports and expand domestic supply. We expect counters within the tile sector, including Royal Ceramics, Lanka wall tiles, and Lanka tiles, to benefit, considering that the import ban on tiles is expected to continue through financial year 22, the heightened demand experienced in the market that outpaces supply, improvement in revenue and margins due to moving into production of luxury larger tiles, and capex investments being made by the companies, including RCL and Lanka wall tiles, to enhance their capacity such that local manufacturers gain market share of nearly 95% by the financial year 2024. From November 2005 to May 2009, during President Mahinda Rajapaksa's administration pre-war, the currency depreciation was recorded at an average of 3.7% per annum. Post-war, through to Jan 2015, depreciation was at an average of 2.4% per annum. In the Yahapalana regime, depreciation was at an average of 6.5% per annum. An annual average depreciation of 7.2% has been recorded under the current regime. 650 billion rupees was printed in 2020 to finance the government as tax revenues fell. Foreign financing was also not an alternative option due to increased risk premiums associated with Sri Lanka being downgraded to CCC. The Central Bank of Sri Lanka has printed 168 billion rupees year to date. Accordingly, we expect similar depreciation of the currency in 2021. As you can see in the graph, the LKR has depreciated against most major currencies in 2020 and 2021. I will now hand over to my colleague Hasita to discuss the counters that are well placed to benefit from the expected rupee depreciation.
Thanks, Divya, for the update. Let's move on to the expected impact on CSE as a result of currency depreciation. We expect quite a few listed companies with exposure to USD assets or revenue to benefit in 2021 as a result of LKR depreciation. Since the counters have a natural hedge against currency fluctuations, we expect growth in earnings after other comprehensive income to outpace the broader market and result in expansion of valuation multiples. Starting off with Lanka Holdings, as bulk of its operations are in USD and only 10% of net profit is accounted for by operations in Sri Lanka, we expect the company's performance in LKR terms to increase significantly. LLC Holdings is the largest dollarized group of companies in Sri Lanka. It has positive translation benefits being recorded continuously through the sales proceeds received in USD from the divestment in Prasak. Further, USD 181 million is to be received in May 2022 at a future exchange rate. This will again add to additional translation gains. The possible divestment of 9 microfinance companies across Asia and Africa may result in additional capital gains and dollar reserves in future years, leading to additional translation gains. As you might know, Brown's Investments PLC has over 80% of its income in USD. Over 70% of its assets are in foreign currency and is spread across multiple geographies, including Sierra Leone and Maldives. The translation gains on foreign currency reserves and revaluation on dollar-linked assets are expected to boost other comprehensive income and boost the NAV of the company going forward. The $1 billion USD asset in the subsidiary Colombo International Financial Center will also be consolidated in USD in the coming years. Additionally, we further expect dollar-based project investments to be made by the company in the future, which will all result in additional OCI gains for the company. Manufacturing-oriented fabric companies such as TGL and Haley's MGT are expected to perform well in the current operating environment. 100% of its revenues are denominated in USD, with only 65 to 70% of input costs being in foreign currency. The LKR depreciation is expected to improve margins and absolute value of profits. As you can see in the graph, the net incurrence of liabilities recorded reductions of USD 1.825 billion in 2020, and the net acquisition of assets recorded a reduction of 1.566 billion in 2020 as well. The reduction in liabilities were primarily due to outflows at point of maturity of the international sovereign bond. Other outflows included foreign investments in rupee-denominated securities and net foreign investment outflow from the CSE amidst turmoil in global financial markets. Of the portfolio investment outflows, 9.1% was from equity and 90.1% was from debt securities. $13 ISBs totaling to $14 billion are in issue at the moment and reaches maturity between 2021 and 2030, of which USD $1 billion falls due in July 2021, USD $2.5 billion falls due within 2 years, and USD 4.9 billion falls due within 3 to 5 years. As I'm sure you already know, 3 rating agencies downgraded Sri Lanka's sovereign rating during 2020. On September 28, Moody's downgraded the rating to AAA1 from B2. on 27 November, Fitch Ratings downgraded the rating to CCC from B minus. On December 11th, S&P downgraded ratings to CCC plus / C from B minus / B. These downgradings were a common occurrence in 2020 due to the pandemic across the globe. And Sri Lanka was no exception to this rule. Concerns were also expressed by these agencies on the external debt position heightened by the pandemic and the expected fiscal deterioration due to the reduction in direct and indirect taxes. Despite concerns, the government repaid the USD 1 billion ISB that matured in October 2020. As a result, the gross official reserves stood only at 4.1 billion as of March 2021, providing just 2.9 months of import cover. The government has successfully obtained loans and swaps to improve these reserves post March 2021. As you can see in this graph, although the bond yields widened at certain points when the country rating was downgraded, the yields have since then declined and stabilized. This reflects the investor confidence in the government's ability to meet its debt obligations after considering the receipt of loans and swap arrangements. As you can see in the graph, in 2020, Sri Lanka's debt to GDP increased to 101 from 2020 from 86.8% in 2019, with domestic debt accounting to 63% of total debt. This was due to the financial stimulus provided, along with the reduction in nominal GDP, contributing to the debt to GDP indicator deteriorating. When looking at the peers, IMF estimates debt to GDP of Pakistan and India to deteriorate to 87 and 86.6 as well, given the extraordinary circumstances associated with the pandemic. Sri Lanka expects to normalize debt to GDP in 2021 and 2022, with the expected increase in nominal GDP. It is important to note that despite all the concerns of rating agencies, all debt obligations were serviced in 2020. The gross official reserves declined from 5.7 billion to 4.1 billion in March. CBSL currently is engaged in raising additional interbank swap arrangements to meet debt repayments and bolster reserves. As you know, in March 2021, CBSL entered into a swap agreement with China for yuan 10 billion, which equates to USD 1.5 billion and is valid for a period of 3 years. In April 2021, Sri Lanka signed a 400 million loan with China, which is the second installment of a USD 1 billion loan. At the end of March, foreign currency reserves stood at USD 4.1 billion, which amounts to 2.9 months of import cover. This will improve in the coming months with the addition of swaps and that were listed above. As you can see, in 2020, the budget deficit expanded to 11.1% from 9.6% in 2019. The expansion of the fiscal deficit was increased due to the relief measures and subsidies provided to businesses and individuals affected by the pandemic. The decline in government revenue due to tax concessions and subdued economic performance saw the fiscal deficit widen. The deficit was largely financed through domestic funding sources. Listed corporates, however, benefited from tax concessions announced in January 2020. For some companies, only took such changes into account on the 31st of March 2021, which in turn boosted earnings due to tax revisions. The Institute of Chartered Accountants of Sri Lanka issued a guideline in April 2021 on application of tax rates in measurement of current tax and deferred tax. Based on the guideline, financial statements having a period in 26 March 2021 should use the proposed tax rule and rates in the bill for determination of current tax and deferred taxes. Accordingly, the following tax rates are applicable. Exports, healthcare, tourism, agri-processing, and construction sectors are taxed at 14%. Manufacturing is taxed at 18%. Business and investment income is taxed at 24%. In the event a company applied a standard rate of 28% for the comparative period in 2020, the said company benefits through a tax reversal, which will be brought in the fourth quarter financial year 2021 financials. The tax rates stated above take effect from the 1st of January 2020. Moving on to the balance of payments, as a result of the moderate inflows and significant external debt repayments, the overall balance of payments recorded deficit of 2.9% in 2020, amounting to a deficit of 2.328 billion, compared to a surplus of 0.4% recorded in 2019. To sum up this presentation, we would like to state that Sri Lanka is following a pro-investment policy with a focus of generating FDIs. The Colombo Port City Economic Commission Bill and the Strategic Economic Zone is expected to better position Sri Lanka to entice FDIs. Going forward, Sri Lanka will limit exposure to foreign loans on commercial terms. However, Sri Lanka will work with development agencies such as World Bank and ADB to avoid an external debt trap. As stated previously, all debt obligations are expected to be met in 2021 and 2022, which might result in an upgrade in Sri Lanka's credit rating, boosting investor confidence. The low interest rate environment will promote listed firms to utilize cheap cost of funding and expand operations, increasing its earnings. Investors in the CSC will also have the ability to take advantage of low interest rates to enhance equity portfolio returns through leverage. As stated earlier, the government has implemented a conducive investment environment through tax reforms promoting FDI. The revision of international trade taxes, simplification of taxes and favorable tax policies for agriculture and livestock, information technology, and construction are expected to promote new investment in these sectors, fueling GDP growth and increase in earnings for listed companies in subsectors. Finally, we would like to state the expected boost in investor confidence and the attractive market multiples should increase inflows from foreign funds into the CSC going forward, boosting liquidity levels. Thank you very much for joining this macroeconomic update, and hope you join our next webinar on technical analysis later this week. Thank you.